So let's come to the question and answer session. So we do this every Friday. The idea is to connect with you and try to solve any queries that you may have to the best of our abilities. See, we have answered 625 queries till date. We've done 33 such rounds. So every time we do about 20 questions odd. You can go through all of them. They are available in the description below. Pranshu says, I'm a long term investor but a bit anxious about the certain current situation. Should I stay or exit? How to develop the mindset? So, I don't blame you for being a bit anxious. I mean, that is the situation in the market, but maybe you are like a recent investor, and maybe this is your first or second big fall in the markets that you are seeing. Um, my own experience is that as you will go through two or three such cycles, you will realize what is that way of investing which works for you. So some people are happy to try and sit out of the market when the market falls, use some mechanism to have a blanket, maybe like if the Nifty breaches 200 DMA, I'm going to get out of the market and wait. Some others may have a strategy that I'll follow my strategy, and follow it in a more passive manner. So like the index never exits, right? So index stocks are always there in the index whether market falls or rises. So you may sort of try to beat the index by having a strategy on the index, saying that I'll continue with the market wherever it goes, but ultimately I want to beat the index. So that one is a tactical orientation, the other one is more passive kind of a situation. But psychologically, to build that mindset, some experience is certainly needed. The more you are able to go back and see what happened in the last 30 years, we have very good data available for last 30, 35, 40 years, how markets uh, went into deep crisis, how they recovered, how much time they took, what would you have done, had you stayed on, how would it have impacted had you gotten out, and how would you have decided to get out? Because in hindsight everything looks very, very simple. The idea is that to go and study that and appreciate that you have to bear some pain to get this added advantage of the alpha that we are able to get in the markets. Otherwise, if the markets are not going to give you this volatility, then they were not going to give you any upside returns as well. And when portfolios are smaller, you are younger in age, you are able to exit quickly, nimble footedly. But say by grace of god, if your portfolio start to become large, I mean, no large investor quits the market, because they can't actually. The kind of cost that will require, the long term advantages that they may be having on their positions, and just the psychology that we don't want to get out of the market, because in a year only maybe 20 days are those days which will create most of the gains, and those 20 days may be lumped together, and they may be very near the bottom. You don't know where the bottom is. Let's say today was the bottom, for instance, and you are out of the market. Now suppose the next 3 days are huge up days, and you will psychologically find it very difficult to enter with the entire amount, let's say Monday morning. So you will miss a significant part of the return journey also then. So the idea is to find your sweet spot, basis your psychology, how risk averse you are, or how you train your mind to deal with the pain. I think these are some of the thoughts I have on this. Deepak says, hi sir, if we are following trend in a stock in a discretionary system, what is the most effective way to pyramid up in a stock? So pyramiding up is a high skilled strategy, unless you are very mentally sharp about how their system is going to work and how you're going to exit once the exit happens. If, I mean, you have to be extremely sharp about it, because you are entering at 100, and then maybe basis some rule you're entering at 120, and then some rule you may be entering at 140, and then the stock starts to drop, so you have become top heavy by then. And if a stock starts to drop fast, you've actually lost all your profit, even while just a little bit of a drop in the. So you have to figure out what is that way in which you will be able to successfully pyramid, because in bull market pyramiding up is very easy. But when markets are not in a full bull mode, pyramiding can be a disaster as well, because you built a pyramid and next morning your stock opens 20% down, your entire pyramid has gone for a bust. So test it out, figure out different, like some people will do pyramiding up like three positions only. Some people will do very small position at start, then double the position, then double the position, and then go no more. So there's no one right way, but there are many ways of doing it, and there are several masters of this trade, but they are mentally very very sharp. They are extremely ruthless when it comes to execution of trades. That mental makeup is very important for that. Jagan sir says, in momentum investing, Sharpe ratio or other ratios are important. Will a particular strategy only work for a particular universe? Backtested strategy for Nifty 200, but Nifty 50 failed. It is very much possible that uh, a particular strategy may work for a particular type of universe, because each universe is behaving very differently. Like just take the example of Nifty 50 and Nifty Junior. Both are large caps, but there's a huge difference in how these two universes behave. Maybe because of extreme, contra derivatives position in Nifty stocks, where nothing really is left for imagination. They are over researched and over owned stocks. Nifty Junior maybe of a different variety. So yeah, I mean some tweaking. It's just like that one car engine, but it is tweaked for different purposes. So the same 1000 cc engine can have a lower fuel efficiency but higher torque, or the same engine can be tweaked for getting more efficiency out of it, and slower acceleration on that. So all kinds of things are possible. Depends. Sharpie ratio could be a filter for eliminating stocks if you want to design it that way. But if you don't want, then that's okay. Supriyo says, I am a MI20 subscriber, and every time I rebalance, I put some money as SIP, but it picks up minor incremental changes, and then in SIP it picks again, unnecessarily causing churn and waste of extra money. I've been asking them for rebalance and SIP together feature since ages. So, Supriyo, this is a platform related issue. I appreciate your point, but the best way to do this is to rebalance first, and then you add your SIP. And if that is a expensive proposition in terms of costs, then you club few SIPs together and do invest more once in a while. That is also a good option to do. Hey Masundar says, I remember you're saying if someone has both HNI and CC and HNI WB strategies, there is nothing else required. Please so the context is that if you want to cover the entire spectrum of the market, then HNI Capital Compounder is a large and mid cap strategy, and HNI Wealth Builder is a mid and small cap strategy. HNI Capital Compounder is a rotational strategy. HNI Wealth Builder is a absolute momentum strategy. So essentially, it covers the entire spectrum of the type of momentum strategies, as well as the different market segments of the market. So if you have both of these, you don't have to go for any third strategy. That is the idea. Ayush says, what strategy would work with all cap? So all cap is it's a flexi cap strategy. That is a strategy good in itself. You don't really need anything else with it. But if you want to add a flavor of, let's say, only more large caps, you could go for a NNF10 or something like that. Or if you want to add large mid caps with the gold hedge, you could add evergreen with that. So those are the kind of things that you could do. But of course, take your call. I really cannot give you any direct advice on this. Ashwini Kumar says, where do you see Nifty 50 in 2030? I hope higher than here. I really have no way to predict where we are going. But given the fact that India is on a growth trajectory, even though lesser or more basis few years of the change that is happening, you could see a long-term trajectory going up. There is no doubt about that. So, there could be periods where Nifty may not go up while the economy is doing well, and there may be periods where the economy may start to sputter, but Nifty is catching up or going further. So I would hope that we are on that growth path of 12 to 14% kind of a uh, CAGR on Nifty for a long period of time. Uh, I don't have a name on this. Thanks for the YouTube content. I have a lot of knowledge of the stock market, but I really struggle to execute trades in real time. I have difficulty deploying large amounts of cash in stocks, even though I have conviction on stocks. So the only two three things that you need to take care of here is, if you are building a long term position or portfolio, always go gradually. So let's say, you have a lot of knowledge and you have significant, amount of cash to deploy 10-20%, let it stabilize, allow it to make 10% gain or 10% loss, whatever. Then you introduce the next 10-20%. Only allow that much money to go in till some buffer is getting created. Let's say over a 2 year period of time, you've deployed, let's say, 40% of cash, but you now have a buffer of 20% on top of it. Now you will have more conviction to deploy the next 20%, next 30%. So most of the people will make this mistake of jumping in with large amounts in stocks, and then when this fall 30%, they will get jittery about it. So always try to create some buffer, some cushion with each step forward, so that, with, like somebody said, I have 100 rupees in the bank, but I don't have the heart to invest in equities. So 100 meaning a sample, like it could be 100 lakhs also. So so I said, why don't you invest, let's say, 10% this year? Okay, you invest 10% 1st of January, and just in whatever vehicle, I mean, fund, small case, whatever, whichever way, but self-correcting mechanism. At the end of the year, what will happen? You have 90 rupees in the bank, that will give you your 6%, 7%, whatever you're getting there. So you are already at, let's say 90 will become 95 there. And this 10 rupees at worst will become 5, at best may become, let's say, 13, 14, right? So let's take worst case scenario. You've lost 50% of your capital in year 1. Your 10 rupees invested has become 5. Okay. So your 90 became 95 in the bank, and you have 5 left here. So at the end of the year, you are still at 100. You started at 100. At the end of the year, you have only 100, but now you are sitting at virtually at the bottom of the market. So let's say you deploy 20 more now. In the next 1 year, let's say market doesn't do well. Maybe it goes up 5%, 10%. In the next 1 year, maybe it still doesn't do well, and you allocate some more. But now you are at a position where market has tanked. It is on consolidating, and now it is going to make that move up. So there is that's the that year is where you will really make the big money. Or in the other case, if the market continues to fall down 20% for 2-3 years, let's say, just for example's sake, then you deploy 10%, 10%, 10% each year. What will you lose? You will lose maybe 6-7% total, maybe 10% total. You already have 70 as the buffer, and that 70 is also earning you maybe 3-4 rupees, 3-4% per year, 3-4 rupees per year. So at the end of the day, you will find that it is not so difficult to gradually come into the market. But when you want to come in lump sum, then you will start to feel jittery, and you may have sleepless nights. You have to be mentally prepared that I'm putting this much in the market. I'm mentally prepared to see it go at least 50% down. Once you have that conviction in yourself that yes, this money can go 50% down, but I know it will make much more after that. If you have that conviction, then gradual entry will help you. I hope it answers your question. I don't. Snape 57 says, how to get a disciplined process to do SIP each month. I often stay back thinking we'll invest once they come down a little. I know in the long run they don't matter, but which week of the month is advisable? Third Thursday or third week for a consistent process? Please guide. Thanks for everything else. So you were very welcome. But I have never believed that there is any one auspicious day for investing. Just choose one day, whichever it is for the month, and blindly just do it. No need to try and time it that this week market is up or next week market will be down. If you are thinking 10 years, 20 years, this will not matter at all. And just create automatic process, and in your mind write off that money. Don't even think about that money. That is the only way to create a disciplined process. Have So that will happen when you don't put your all your eggs in one basket, right? So I keep talking about asset allocation and all those things. It is for that matter that you, if one asset class doesn't work for some time, that's not the end of the world, and that's how you will build allocations over a period of time. Um, so the whole idea is that there you should have some automatic withdrawal from your account, going towards your SIP, just like you pay for EMI for your car or EMI for your house. This also should be like a gun to your head that you have to pay. There is no holding back. So when you can pay a EMI for a car which is going down the drain and it will not result in any returns, that is a expense virtually. Then this also you think that way, that okay, this money is going, I don't know, I'll see in 5 years what happens to this. And you take out the last 30 years of data and you find that any 5 years nobody really made any big losses. You may have some poor returns in certain phases of the market, but nobody's really lost big money over 5 years anytime you see. So go with that confidence, I think. Ragna, I'm sorry, Repaka Sarth is saying, I was checking the long term returns of weekend investing strategies and other than MIEG, I suppose Evergreen. Others are close to 12 in 3 year returns if we consider transaction and subcourse it's equal to mutual funds. This is because of bear market seen in this time. I am happy with your strategy. So very nice that you are happy with our strategies. Uh, I really can't say about the performance because I'm not allowed to, but all the performance is transparently out there. I can tell you this much that this, this talk about transaction cost, this talk about taxation, and all that is so much in small case and this and that. You do a very simple math. Let's say mutual fund gives you 12% return, just for argument's sake, I'm saying, and you hold it for long term. You will pay 12.5% on that, right? So maybe let's say 1.5 rupees will be paid in tax. Now let's say a small case makes 14% returns, just 2% more than uh, the mutual fund, and all small case returns are x of dividends also. So assume 0.5%, 1% dividend also will come. Let's keep that aside. Let's assume most of the transactions will get taken care of in that cost. So this additional, and let's assume everything is short term capital gain, although it is not, but let's say everything is short term capital gain. So what will you pay? You will pay on 14%. You'll pay what, 2.8 or something, right? So the idea is that on one hand, at 12%, you were paying approximately 1.5 rupees. Here you are paying 2.8, some difference like that. So it is very, very close. So I think the difference that comes, and I can share some calculations which I'm not getting on top of my head, is about a couple of percentage points for most cases. So if your small cases are able to generate a couple of percent more, you are even with all kinds of you know uh, vehicles. So that is dependent upon each small case. Some small cases may do well, small cases may not do well. Mr. A. Mandirata says everybody seems to be talking about momentum investing these days, including news anchors. If it becomes an overcrowded train, would the system stop working with returns drying up? So, while theoretically the question is right, in the US, for instance, they've done 200 years of studies on the data. They have that kind of data. We don't have that kind of data. Um, and you need to understand why is everybody talking about momentum investing, why it is becoming more popular, because it has been proven with data that the returns that you are able to generate in momentum investing are superior to all other factor investing, whether it is value, quality, size, etc., so on and so forth. So henceforth, and of course it is easier to manage, execute, and so on and so forth. So gradually people are veering towards this, but it is still a trickle uh, from that point of view. And I would imagine that, you know, uh, you have maybe a few percentage of AUM, not even that much, maybe less than a percent, which actually is running on momentum, because it is counterintuitive. Fund managers who are even doing momentum don't want to call it momentum. They will, have it under garb of something else. So there may be periods where, momentum may not perform as well as it is expected, but overall I don't see any reason of it to stop working anytime soon. I mean, anytime soon meaning, I mean, next few decades I don't see that it happening in India at least. Him has another Hame clone. I hope you are the real one who's asking the questions. Okay. What are the key advantages of AIF via momentum style versus value or growth? What is the maximum percentage of portfolio that can be in AIF? So AIF is a vehicle which is a pooled account. So the manager is managing a pooled account versus, let's say, a PMS where each portfolio is segregated in each different demat account of the user. AIF is a pooled account. Uh, the advantage that I foresee in that is that the entry exit impact cost can be greatly reduced in AIF versus the current market order driven system that we have. So for larger users, larger orders, the slicing of the order or gradual order entry makes, even if a few basis points per order are saved due to that, it adds up quite a bit over the year, and that becomes the major advantage of the pooled vehicle of the AIF. And of course, somebody else is managing, you don't have to manage it. That is the advantage from the client perspective, etc. The percentage of portfolio that can be AIF could be anything. You could put all your money in different AIF. There are, I think, 1,500 AIFs in the market. There is no limit on that front. But the minimum entry level is about a crore. Jeba Raj says, over a period of 7 years or more, if MI top 10 follows absolute momentum strategy. So first of all, absolute momentum strategy is not followed by MI top 10. So you can't really compare that. MI top 10 2 follows rotational momentum strategy. What would be the absolute? No, you can't compare this. I mean, it's like saying that what will, I mean, if my car has a BMW engine, and what if I put a Mercedes, how will it perform? So this question is, in my view, not a valid question. You may say, how does absolute momentum strategy compare with rotational momentum strategy? They will both have their own advantages and disadvantages. Absolute momentum strategy will go to cash. Like right now, we are sitting in 70-80% cash in several strategies, 50%, 60% in absolute strategies, but rotational, because of its nature of strategy, are fully invested. So right now there is some disadvantage that we are seeing in terms of the drawdown, but once the market starts to pick up, absolute momentum strategies will take time to get reallocated to constituents, whereas rotational will start making money from day one when the market starts. So over a longer period of time, each has its own advantage. It is basically more of a psychological, advantage of one versus other. What suits somebody's thought process is what sort of uh, makes the difference between the two. So I'll come back to this question, which I think I made an error in the calculation. So if you are doing a 12% on long term, and you made 1.5 rupees in tax, you get net 10.5. And if you're doing 14 on the small case, you have to subtract 2.8 from there. So you are at 11.2. So I mean, the gap actually is less than 2%. I mean, it may be even less than 1.2 or 1.3%. So it is very, very close. But in theory, it on when somebody tells you about this gap, it seems 20%, 12%. But actually, when you do the numbers, it is not as much. So that's the point that I was trying to make. Came back to me after a while. Okay. Gaurav says, during these days when Trump is imposing tariffs left, right, and center, how are US market so stable? So maybe US markets not yet realizing that this all this tariff business is going to hurt them the most actually, potentially. Uh, uh, and right now there's a rush of money towards the US markets from everywhere in the world. US dollar is very strong, so they will have their own period of downfall when they do. If you go back and see the entire decade from year 2000 till 2010 odd, S&P 500 has zero returns, and Nifty went almost like from 1,000 odd in the year 2000 to maybe 6,000, and even in dollar terms it went up quite a bit. So there will be decades where US market will not do well. Um, So this is where we end today's Ask Weekend Investing round. I hope some of the queries that you posed, I was able to answer and satisfy your query. If not, send me a mail. I'll try again, and or we'll take it up in the next episode. All the previous episodes are here. Please go through them. It's a great knowledge database, not just about weekend investing, but about markets, about small case, about all kinds of queries people have asked in this. So it's a great repository that one can go through and enhance your knowledge about. So thank you so much for watching. Do like and share these videos and do subscribe to the channel. Thanks. Bye.